At dawn in Washington and dusk in Beijing, two economic superpowers rewrote the rules of global trade with a single signature. The US-China trade war swung from punishing 145% tariffs to a fragile 10% truce, reshaping markets, power, and trust worldwide. In early 2018, inside the West Wing, the language of trade hardened into something sharper. Legal briefs replaced diplomacy. Spreadsheets became weapons. Under Section 301 of the U.S. Trade Act, Washington formally accused Beijing of intellectual property theft, forced technology transfers, and systemic unfair trade practices. What had simmered for years was now documented, itemized, and prepared for action. At that moment, global trade still followed familiar rules. Average tariffs were modest, roughly 3% of U.S. imports, around 8% of Chinese goods. Numbers small enough to fade into the background of daily commerce. Containers moved. Factories ran. Consumers rarely noticed the cost of globalization ticking quietly beneath prices. But Beijing's rise had unsettled more than balance sheets. Trade deficits widened. Supply chains grew dependent. Strategic anxiety crept into economic policy. In Washington, trade was no longer just about money. It was about leverage, about technology, about the future shape of power. The first tariffs landed deliberately: steel, aluminum, machinery. China answered in kind: soybeans, automobiles, industrial goods. Each response is calibrated. Each escalation is measured. Yet with every move, restraint thinned. The dispute expanded beyond goods into ideology. State capitalism versus market liberalism, control versus openness. What began as a legal investigation turned into a structural confrontation. Tariffs were no longer corrective tools. They became signals, messages sent across oceans and trading floors. And beneath the official language of fairness and reciprocity, a deeper question surfaced quietly. Could two intertwined economies still compete without breaking the system that bound them together? History suggests moments like this rarely stay contained. They accumulate, they compound, and eventually they force a reckoning far larger than the dispute that sparked them. By early 2025, the trade war crossed a threshold few economists believed possible. What had once been incremental pressure turned into blunt force. In Washington, tariff schedules were revised upward with startling speed. Duties on key Chinese imports surged to 145%. At that level, trade was no longer being taxed. It was being throttled. Beijing responded within days. Retaliatory tariffs climbed as high as 125% on American goods. The symmetry was deliberate. Each side signals resolve. Each side demonstrated it would not absorb economic pain quietly. These were not accidental numbers. They were political statements designed to be impossible to ignore. Publicly, the justification followed familiar lines: protection of domestic industries, defense against unfair practices, rebalancing trade. But beneath the language of policy sat a deeper strategic calculation. Tariffs had become leverage, pressure points meant to force negotiation by raising the cost of inaction. Every percentage increase narrowed the space for compromise, yet paradoxically made talks more urgent. The immediate effects rippled outward. Global supply chains, finely tuned over decades, began to stutter. Components stalled at ports. Orders were delayed or canceled. Manufacturers faced unpredictable costs week to week, sometimes day to day. Inflationary pressure crept into consumer markets as importers passed costs downstream. What had once been invisible trade policy now appeared on price tags. Financial markets reacted with unease. Stock indices swung sharply after each announcement, rising on rumors of talks, falling on confirmation of escalation. Currency markets reflected the tension. Capital moved cautiously, seeking shelter from uncertainty rather than opportunity. Certain industries felt the impact faster than others. Toy manufacturers saw margins collapse almost overnight. Electronics firms struggled as components became prohibitively expensive. Steel producers faced retaliatory closures abroad. Farmers, especially exporters, watched foreign markets evaporate as tariffs erased competitiveness. Each sector told the same story in different accents. Trade friction had become economic gravity. By mid-2025, it was clear this was no longer about correcting imbalances. It was about endurance, about who could absorb disruption longer, and whether the global trading system itself could withstand such sustained pressure without permanent damage. For businesses caught between policy and production, the escalation was not theoretical. It was immediate. Import costs didn't just rise, they tripled in some cases. Contracts written under stable assumptions became liabilities overnight. For many firms, absorbing the shock was impossible. Decisions once planned over years were suddenly made in weeks. Some companies relocated production, others dared to diversify suppliers. The phrase China plus one moved from boardroom jargon to operational necessity. Vietnam, India, Mexico. Any alternative that reduced exposure to tariffs became attractive. Even if efficiency suffered, shipping routes grew longer, timelines stretched thinner, resilience replaced optimization as the guiding principle. Small and mid-sized firms struggled the most. Lacking the capital to restructure quickly, many reduced output or exited markets entirely. Larger corporations adapted, but at a cost. Fragmented supply chains, higher logistics expenses, and lost economies of scale. The promise of cheap, seamless globalization faded into something more cautious and regional. Consumers felt the consequences, quietly but persistently. Everyday goods grew more expensive. Electronics, household items, children's toys. Price increases arrived incrementally, often unnoticed at first, then impossible to ignore. Inflation was not driven by demand or wages, but by friction. Policy-induced scarcity moving invisibly through the system. Markets mirrored the uncertainty. Stock indices reacted sharply to tariff headlines, sometimes gaining thousands of points on hints of de-escalation, only to reverse on confirmation of new duties. Currency volatility followed. Investors adjusted expectations, not around growth, but around risk management. Shipping delays became routine. Ports slowed, insurance costs rose. Long-standing supplier relationships fractured under the strain of uncertainty. Trade, once governed by predictability, became provisional. Yet beneath the disruption, adaptation was underway. Businesses learned to operate in fragments. Consumers adjusted behavior. The system bent rather than broke. Still, a lingering question remained unresolved. If global trade could be shaken violently by political decisions, what stability truly meant in the modern economy? And as costs accumulated quietly across households and balance sheets, pressure for relief began to rise. Not from ideology, but from reality itself. In May 2025, the escalation paused, not with celebration, but with restraint. In Geneva, far from factory floors and trading terminals, negotiators gathered under muted expectations. The agreement they reached was narrow by design. It was not a peace treaty, it was a ceasefire. Under the terms, the most punitive measures were rolled back. U.S. tariffs fell from an extraordinary 145% to 30% on key Chinese imports. China responded by reducing its own retaliatory duties from 125% to roughly 10%. The number signaled relief, but not resolution. Trade was allowed to breathe again, though still under pressure. Crucially, the rollback was incomplete. Section 301 duties remained in place. So did fentanyl-related tariffs and select national security measures. These exceptions mattered. They preserved leverage. They reminded both sides that this was a pause, not a reset. The architecture of confrontation was still standing, merely softened at the edges. Markets responded instantly. Equity indices steadied. Shipping orders resumed. Manufacturers reopened conversations that had been frozen for months. Yet optimism was cautious. The truce was time-bound. 90 days. Long enough to negotiate, short enough to fail. The stated goal was stability, to calm markets, to prevent further inflation, to give negotiators room to talk without the pressure of daily economic shock. Behind closed doors, both sides understood the deeper motive. The cost of continued escalation had become politically and economically unsustainable. But the temporary nature of the agreement cast a long shadow. Extensions were possible, even likely, yet nothing was guaranteed. Businesses planned in contingencies. Investors priced in uncertainty. The truce reduced tension, but it did not remove it. History rarely turns on decisive endings. More often, it moves through pauses like this. Moments where escalation slows. Not because conflict is resolved, but because both sides need time to reassess the damage already done. By late 2025, trade between the United States and China existed in a modified state, neither fully open nor fully constrained. Baseline tariffs hovered above 10% on both sides, far higher than pre-trade war norms. The extraordinary peaks had passed, but the ground never returned to level. Layered atop those baselines were a maze of remaining measures: anti-dumping duties, sector-specific tariffs, national security exceptions. Each one targeted, each one defended as necessary. Together, they formed a complex tariff environment that defied simple calculation. Trade resumed, but under rules that shifted by product, by origin, and by political climate. For businesses, the costs remained real. Even at reduced rates, tariffs reshaped pricing models and sourcing strategies. Margins stayed compressed. Consumers continued to absorb higher prices, though less dramatically than during the peak. The truce softened the blow, but it did not reverse the accumulated damage. More importantly, uncertainty lingered. Tariffs were no longer just economic instruments. They had become geopolitical tools, influenced by technology rivalry, security concerns, and broader strategic competition. Any diplomatic rupture over technology controls, regional conflicts, or alliance structures carried the risk of renewed escalation. Companies responded with caution. Long-term investments were delayed. Supply chains remained diversified rather than optimized. Flexibility replaced efficiency as the primary goal. The lesson of the escalation was clear. Exposure to a single trade corridor carried unacceptable risk. For policymakers, the dilemma remained unresolved. Tariffs provided leverage, but at tangible cost. Removing them risked appearing weak. Maintaining them risked long-term economic drag. Between those pressures, the tariff landscape settled into an uneasy equilibrium. Not peace, not war, but a sustained tension, where trade continued, markets functioned, and yet everyone understood how quickly the balance could tilt again. The ripple effects of the trade war extended far beyond Washington and Beijing. Across continents, factories recalibrated production lines, and corporate headquarters reassessed long-term strategies. Companies no longer relied solely on the historical logic of cost efficiency. They factored in political risk as a primary driver. Global supply chains, once predictable and streamlined, became fluid and defensive. A clear pattern emerged. Firms diversified their sourcing to reduce exposure to tariffs. Vietnam, India, and Mexico became increasingly attractive alternatives, offering manufacturing capacity and trade access outside the direct orbit of US-China friction. Production timelines lengthened, logistics grew more complex, and costs increased, but resilience now outweighed speed. Businesses accepted inefficiency as a trade-off for stability. The shift affected global trade flows in measurable ways. Traditional shipping lanes thinned as cargo diverted through secondary ports. Regional trade agreements gained renewed relevance. Competitiveness became not just a matter of price or quality, but of adaptability and geographic flexibility. Countries positioned themselves as safer havens for manufacturing investment, reshaping the global economic map. Beyond economics, the trade war carried deeper strategic signaling. Tariffs and trade restrictions were not merely financial instruments. They communicated priorities in technology dominance, national security, and supply chain independence. External factors intensified uncertainty. Upcoming elections in the United States promised potential shifts in trade strategy. Economic cycles hinted at slowing growth in key sectors. Geopolitical tensions, from technology rivalries to regional conflicts, threatened to redraw priorities and influence decisions. In this environment, tariffs were no longer simple fiscal instruments. They had become strategic tools used to signal resolve, extract concessions, and negotiate future terms. The broader lesson remained clear. Short-term pauses in tension did not guarantee long-term stability. Tariffs could be temporary shields or enduring barriers, depending on political will and global dynamics. Markets and businesses, now attuned to volatility, would continue to navigate uncertainty, ever mindful that the next round of escalation could arrive suddenly, reshaping the global economic landscape once again. The US-China trade war shows how quickly global commerce can swing from extreme tariffs to tentative truces. Markets, businesses, and consumers adapt to uncertainty, while the world watches to see if this fragile 10% truce holds, or if we're headed for the next round of economic whiplash.